Have you ever looked at your closing disclosure right before closing and thought, wait, why did these numbers change? Did your lender make a mistake? Was it legal? Or were those costs never really locked in to begin with? Today, we're going to compare the loan estimate directly against the closing disclosure line by line so you can understand what changed, why it changed, and which fee increases should make you ask questions. In the last video, we broke down how to read a loan estimate. Now we're moving further into the process to the closing disclosure. It's sometimes called the CD. The closing disclosure is designed to show the finalized loan terms and closing figures before you sign your loan documents. And by law, you must receive it at least 3 business days before closing. Now, an important thing to understand, the closing disclosure you first receive 3 days before closing may not be the exact same version you ultimately sign at closing. Some figures can still legitimately change before closing. Things like prepaid interest, prorated taxes, escrow amounts, there's homeowner association fees, title adjustments, other transaction related things. But here's the important question. Which changes are actually allowed? And when is the lender required to tell you about them? Because some fee increases are perfectly legal and others can create serious compliance problems if they aren't handled correctly. We'll break down exactly how these tolerance rules work later in this series. Now here's where many buyers get confused. Notice the total closing costs actually increased from the loan estimate to the closing disclosure, but the final cash to close number actually went down. At first glance, that might make it seem like the loan became less expensive, but look deeper. Cash to close includes things like deposits already paid, appraisal fees already paid, seller credits, other adjustments. So even though the amount you still need to bring in at closing may be lower, your total out-of-pocket cost could actually be higher. And later in the video, we'll break down exactly why that happened in this example. Now this is where we really start to see what changed. Page 2 is where all the detailed closing costs are broken down. And honestly, this is where buyers either start to understand the loan or their eyes completely glaze over. But once you know how these sections work, it becomes much easier to compare the numbers. Remember from the loan estimate, the left side of page 2 contained your loan cost. On the closing disclosure, those same costs are now spread across the top section so you can see who's being paid and whether it was paid before closing and who actually is paying it. Now let's focus on section A because this is one of the most important areas to compare carefully. These are lender-controlled charges. This is where you typically see your origination fees, points, underwriting fees, processing fees, and any other lender-related costs. And remember from the last video, lenders can sometimes get pretty creative with the names of these fees. Sometimes a low advertised rate gets offset by higher lender fees hidden in this section. Now in our example, notice these costs increased from the original loan estimate. That immediately raises an important question. Was that increase allowed? Because these fees fall into what's called the zero tolerance category, meaning they generally cannot increase unless there was a legitimate change in circumstance. In this example, the interest rate itself stayed the same at 6.25%, but the cost of that rate increased from a quarter point, or 0.25, to 3/8 of a point, or 0.375. That increased the borrower's cost by about $593. And this is something many buyers don't realize. Mortgage pricing changes constantly. The actual interest rate may stay the same, while the cost of obtaining that rate, the points, moves up or down daily, sometimes even multiple times in the same day. Now, because this happened when the borrower locked the rate, the lender is allowed to redisclose those updated costs. Side note here, if a lender repeatedly delays locking your rate you're interested in locking while costs continue increasing, that's something you should ask some careful questions about. And remember, when these lender-controlled costs increase, the lender must provide updated disclosures explaining the change. Another thing to notice here, the appraisal fee still appears in the total closing cost, even though the borrower already paid for it earlier in the process. That becomes important later when we compare the final cash to close numbers. Now let's move into the other costs section. These are costs tied more to the property and transaction itself rather than lender charges. In our example, the homeowner's insurance premium came in slightly higher than originally estimated. That means the prepaid insurance amount increased, and the escrow account needed a little more money collected up front as well. And this is a good example of a fee category that can legitimately change. The lender doesn't control your insurance premium, so there's no strict tolerance limitation on that increase. You'll also notice an escrow adjustment credit back to the borrower. Well, what's this? Escrow laws limit how much cushion the lender can collect and hold in the account. So after calculations on the escrow balance and the balance as the year goes on, they basically need to collect a bit less than those full 2 or 3 months worth of taxes or insurance. So you see the full 2 or 3 months broken down for escrow setup with that aggregate adjustment getting the account balance in line with the escrow limit law. Now, here's another important change. Remember the optional owner's title policy from the loan estimate? Originally, it appeared as a borrower cost because the lender had not yet verified who would be paying it. But by the time we reached the closing disclosure, the contract confirmed the seller was paying that fee. So even though the cost still appears on the disclosure, it's now being paid by the seller instead of the borrower. And of course, the buyer was already expecting the seller to be paying that fee. So at first glance, it may look like the total closing cost actually went down, but look a little closer. The seller paid owner's title policy offset some of the increases we saw elsewhere. And honestly, in many purchase transactions, the buyer and seller may have already agreed in the contract that the seller would pay this fee from the beginning. This is very common in Colorado and in other states. The lender simply may not have fully verified that yet when the original loan estimate was issued. So this wasn't really a new discount or a sudden savings later in the process. It was more of a clarification and final allocation of who was actually paying the fee. The bottom line is the lender cost increased by $593. And now we can finally explain why the cash to close number actually decreased earlier, even though some closing costs increased. Remember, cash to close includes deposits already paid, appraisal fees already paid, seller credits, tax adjustments, other credits that come up. So while the amount still needed at closing went down, the borrower's total out-of-pocket cost for the transaction actually increased slightly. The important thing to remember is the closing disclosure should not feel like a completely different loan suddenly appeared at the last minute. Most changes have explanations. The key is understanding what changed, why it changed, and whether those changes were actually allowed under the mortgage regulations for tolerance rules. In the next video, we'll break down the actual mortgage tolerance rules in detail, which fees cannot change, which fees can change a little, and which fees can legally change by any amount, and when your lender has to absorb the difference. Because once you understand those tolerance buckets, you can spot potential problems very quickly. If this video was helpful, I'd appreciate it if you'd like and subscribe, and let me know in the comments, have you ever had closing costs change unexpectedly?